What do legendary investor Benjamin Graham and billionaire Warren Buffett have in common? How do some investors seem to be making profit hand over fist, regardless of market turbulences? And how do some people start with a small capital and make millions over the years through investing? The answer to all these questions can be summed up in two words: value investing. In this episode, we're going to explore what value investing is, why many consider it to be the most efficient investing strategy, and how you can start using it straight after finishing this video, in 4 comprehensible points. Let's get into it. Number 1. First of all, let's add meaning to terminology by briefly explaining what value investing actually is. Think of this scenario. You're going to buy a restaurant and the owner is asking for $500,000. How do you determine whether that's a reasonable price to pay for this particular restaurant? There are a few factors to consider. For instance, how much profit is the restaurant making each year? What kind of assets does the restaurant own? What does it have in the way of debt? How long has it been operating? And are its profits consistently going up? Value investing asks similar questions when buying stocks in a company. It's a strategy that's based on picking stocks which appear to be trading for less than their intrinsic value. Well, what is intrinsic value? Simply put, it's the real calculated value of a company, stock, or product determined through fundamental analysis regardless of the price its stocks are exchanging at. The key in value investing is actively looking out for stocks the market is currently underestimating, which means that they're being exchanged at a value lower than the company's intrinsic value. Value investors know that the market overreacts to good and bad news, resulting in stock price fluctuations that do not necessarily reflect the company's long-term fundamentals. This overreaction presents an opportunity to buy valuable stocks at discounted prices. So in short, value investing is a strategy that looks beyond the current price of stocks and instead focuses on the real value a company offers in the long term. Number 2. Now, you might be thinking, if a company has a substantial real value and its future seems promising, why would its stocks be trading at relatively cheap prices? There are a few factors that can drag a stock's price down and make it undervalued. 1. The herd mentality. Sometimes people invest based on psychological biases rather than market fundamentals. Even the most prominent investors fall into this trap. When a specific stock's price is rising or when the overall market is rising, people buy. They think that if they had invested 12 weeks before, they would have made a 15% profit by then, and they develop a fear of missing out. On the other hand, when a stock's price is falling or when the overall market is declining, people start selling to avoid loss. This behavior is so widespread that it affects the prices of individual stocks, accelerating both upward and downward movements. So, sometimes a stock would seem to be doing worse than it actually is because of too many people following the herd mentality and selling. 2. Market crashes. When the market reaches an unreasonable high, a bubble usually follows. Stock prices increase so much that it becomes unsustainable. Investors panic and it results in a massive sell-off. This causes what we call a market crash. It's what happened in the early 2000s with the dot-com bubble, when the values of tech stocks shot up beyond what the companies were actually worth. It also happened in the famous housing bubble burst and the market crashed in mid-2000s. At widespread sell-offs, real value investors see an opportunity. They know that these stocks will eventually bounce back to their reasonable prices because they understand the real value of companies. 3. Bad news. Or to be specific, overreaction to bad news. Even Fortune 500 companies experience setbacks, like the death of a popular CEO or a product fiasco. But that doesn't mean the company isn't still fundamentally valuable or that its stocks will bounce back. Legendary financial analyst and the owner of the world's largest hedge fund, Ray Dalio, explicitly says that analysts do not have a great record of predicting the future. And yet, investors often panic and sell when a company announces that its earnings are lower than analysts' expectations. Value investors see beyond the downgrades and negative news of a company. They buy stocks at bigger discounts because of their ability to recognize a company's long-term value. 4. Cyclicality. Companies are not immune to ups and downs in the economic cycle. This can be anything from seasonality and the time of year to the consumer attitudes. Certain products sell more at different times of year. This affects profit levels and the immediate price of a company's stocks, but it doesn't affect the company's value in the long term. A good example of cyclical stocks are airlines. Leisure travel is not a necessity. When the economy is strong, more people can afford international vacations. But when times are bad or when there's a global pandemic, people forego travel and focus on affording the necessities. 5. And finally, unnoticed and unglamorous stocks. Value investors look beyond what they see in the news. You may find great investment opportunities in non-popular stocks like small caps or foreign stocks. A small cap is broadly a company with a market capital between $300 million and $2 billion. Everyone wants in on the next big thing, like a technology startup that people predict to be the next Facebook or Uber. Not many want to invest in a boring established consumer manufacturer. For example, stocks like Apple and Google are more likely to be affected by the herd mentality than consistent companies like Procter & Gamble or Johnson & Johnson. That was it for the 5 main reasons why stocks underperform or seem to be doing worse than they actually are. So keep an eye out for these factors before deciding a stock is falling, look beyond the news and the general opinion and focus on the real long-term value of a company. Number 3. Now that you know what value investing is and what affects the prices of stocks, it's time for our 4 rules of value investing, which you can start applying right now. Rule number 1. Invest in companies, not stocks. When a value investor purchases a stock, they treat their investment as if they were buying the entire company. The philosophy of value investing is to invest in companies that have a clear direction, are well established, and are easy to understand. Value investors tend to favor businesses that have proven to be consistently profitable, such as companies involving consumer staples. Rule number 2. Buy and hold. A key principle of value investing is to think long-term. Unlike day traders who often buy and sell stocks on the same day, value investors purchase stocks with the intention of holding onto them for years or even decades. This long-term approach allows you to weather the ups and downs of the market. Stocks tend to be volatile in the short term, but history tells us that over a long period of time, the value of stocks generally rise. Rule number 3. Ignore the crowd. We've mentioned it over and over again, but we just can't stress this enough. When the market overreacts to good or bad news, it results in stock price fluctuations. Look beyond the market sentiment and study the real value of a company. You might think that a certain stock is underperforming, but if you've done a thorough research and have carefully studied the company, you may want to buy more of that stock instead of selling while prices are low, because you know that the fundamentals of the company you've invested in will make it bounce back. Rule number 4. Invest with a margin of safety. Before a value investor purchases a stock, it has to pass the margin of safety test. This means that the current market value of a stock has to be below the company's intrinsic value. Not only below the intrinsic value, but significantly below it. This provides a buffer in case the stock doesn't perform as anticipated. Buying below the margin of safety minimizes your risks. Those were the 4 general rules of value investing, and now it's time for our final tip. Number 4. Drawbacks of value investing. We know that by now you might be thinking that this is the best investment strategy out there, and your eye pupils have turned into the shiny dollar signs. But hold on, before getting into it, consider this. First of all, value investing requires an investor's mindset. There is no room for emotions. While this can make investing easier on one hand, on the other, it can be a challenging mindset to adopt over the long term. As humans, we're prone to making decisions emotionally, and this leads to our downfall as investors. Adopting an investor's mindset means eliminating the emotions of fear and greed from your decision-making process and basing your actions solely on factual data. With value investing, the greatest investment you can make is on yourself and your financial education. Secondly, you need a lot of patience and hard work. Value investing is not the easiest strategy to implement, so you must be willing to do your homework if you want to become successful. Watching your stocks rise in value can sometimes take years, and it's not the most exciting process. This can present a real challenge to investors who crave the excitement of generating big returns quickly. In fact, on most days, value investors will see very little change in the value of their stock holdings. But they are the ones who are making real money over the long term. Finally, a company's intrinsic value can be quite difficult to estimate. This is probably the biggest downside of value investing, accurately estimating the company's real value. There are a number of methods you can use to accomplish this, but all of them require a certain level of expertise, and not everyone has a solid background in finance. In determining the value of a stock, you'll be looking at all the available information about a company, including its past and projected revenues, earnings, debts, and cash flows. But even all this data can't always effectively account for such intangible and unpredictable factors like changing management styles or evolving market competition. In the end, it all comes down to your own skill in research, analysis, and judgment for whether a company's stock is undervalued and subsequently worth buying. Those were the drawbacks you need to consider before getting yourself into value investing. After all, making millions is by no means an easy task. That's it for this episode. We hope it helps you all out there managing your investments. If you found the information here useful, hit that like button. And if you want to support us even more, buy us a coffee from the link in the description. If you'd like to see more episodes on financial advice, hit that subscribe button and turn on the notifications for our latest updates. Let us know if there's anything in particular you'd like us to make an episode about in the comments section below. We hope this helps you awake the latent millionaire inside of you. Happy investments and good luck!